Okay, let's try to unpack this because it is, I think, a monumental financial paradox. It has people in global markets completely baffled.
Like a real head-scratcher, for sure.
We're looking at an economy that is just sprinting. I mean, it reported a stellar 8.2% GDP growth for the July to September quarter.
And that's on top of already strong numbers. It was 7.8% and 7.4% in the quarters before that.
Right. By any measure, this is one of the fastest growing large economies on the entire planet.
It's a huge, undeniable macro success story.
Mm.
It should, theoretically be sending confidence through the roof.
But that's the bizarre part. Here's the reality. This same economy's currency, the rupee, has been one of the worst performing against its peers.
Against BRICS, against ASEAN, you name it.
The market's reaction to this fantastic GDP news wasn't a celebration. It was rejection.
And we saw this play out in real time. Following that GDP announcement on the very next trading day, you'd think, okay, massive rally coming. Instead, all the major financial instruments, stocks, bonds, the currency, they all took a synchronized tumble.
I remember watching the screens that day. The Nifty actually started by hitting a new all-time high of 26,300, a massive psychological barrier.
And then what happened?
Then the rupee's midday slide just triggered a complete U-turn. It dictated the mood for the entire rest of the day.
That's the crucial point, isn't it? The currencies movement completely overpowered the fantastic economic headline.
It's utterly counterintuitive. So how can such a macro success story be so, I guess, undermined by a mix of market sentiment and these micro shocks?
Well, that's what we're here to figure out.
That is precisely our mission for you today. To do a deep dive and decode the specific and often surprising factors that are undermining the currency, to separate that shiny 8.2% headline from the subtle forces driving capital away.
We really need to look under the hood because the plumbing is under serious pressure, and investors are betting against the future of corporate earnings, not necessarily against the GDP print itself.
Let's start right there with that fundamental disconnect you just mentioned. The GDP macro story is flying, but the corporate earnings picture seems, well, deeply meh.
It's stagnant, that's the word.
What are the numbers telling us?
Well, if you track the Nifty 50 earnings per share, the EPS, which is, the primary measure of profitability, it's been growing in the low to mid single digits.
Okay.
For 6 consecutive quarters now.
6 quarters, that's a year and a half of disappointing bottom lines.
Exactly. And this long, lean patch is critical. While the economic growth is strong, the poor earnings performance has meant that stock valuations have looked optically expensive for well over a year now.
So the prices look high compared to what the companies are actually earning.
Precisely. The GDP suggests future potential, but the current earnings reports aren't justifying today's prices. And that causes hesitation among foreign portfolio investors or FPIs.
That makes perfect sense. If I'm an international investor, I look at rich valuations and muted earnings, and my first instinct is to pull back. So what's the actual scale of this FPI capital flight? I've heard it's not just big, it's historic.
It is historic, and this is where we need to stop and really grasp the context. We saw net FPI outflows of $15 billion in the previous fiscal year, FY25.
Okay.
And we are already tracking over $16 billion in outflows so far in this fiscal year, FY26.
So we've crossed the $30 billion mark in outflows across 2 years.
Right. And these persistent heavy FPI outflows have resulted in a capital account deficit for 2 straight years.
And what's the big deal about that?
Well, this is the first time since the rupee's exchange rate became market determined, since we moved away from fixed rates, that India has experienced 2 consecutive years of balance of payments, or BOPI deficits.
Wow. We have had isolated BOPI deficits before, though, right? Like during major global crises.
Yes. We had one during the 2008 Lehman crisis and another during the 2013 taper tantrum. But those were acute, shock-driven events.
Right.
This 2-year consecutive run is different. It's more of a systemic problem, indicating a persistent gap. It shows the capital inflows we need to bridge our current account deficit just aren't arriving consistently anymore.
So it implies a structural weakening of confidence, not just a cyclical panic.
Exactly. That's what truly differentiates this period of rupee weakness.
That's a powerful insight. The underlying mechanism for funding our trade gap is failing. So that's problem number 1, the earnings disconnect driving historic capital flight. Now, let's pivot to the global investor's view. It's not just about what India has, but what the global investor wants.
Precisely. And FPIs are shunning India, partly because the country lacks the flavor of the day, assets. Right now, that flavor is artificial intelligence stocks.
You can't open a financial news site without reading about AI. But, I mean, realistically, how many emerging markets can actually offer institutional AI plays?
Very few. Globally, this concentration is almost entirely limited to North Asian countries, so China, Korea, and Taiwan. India just misses out on that incremental high-growth allocation.
But wait, if India's peers like Vietnam, Indonesia, Malaysia, if they also lack dedicated AI stocks, why are their currencies doing better?
That's a very fair question. And the comparison holds because while they also lack that AI flavor, they haven't faced the same incremental bad news on their trade accounts that India has. And crucially, they've been more successful on the trade deal front.
Ah, the trade deal woes. That brings us to the second major sentiment killer.
Indeed. While these comparable countries have been signing deals that reduce tariffs and boost predictability, India remains an outlier. And traders had pegged a lot of hope on a specific development,
The U.S. deal.
a major trade deal with the U.S. that was widely expected to be signed by November.
And when that didn't materialize,
That hope was unequivocally scotched recently. The market reaction was swift disappointment. Traders immediately began taking fresh dollar-long positions.
in simple terms for the listener,
They were essentially betting that the U.S. dollar would rise against the rupee, directly contributing to the rupee slide, all based on that one missed opportunity.
so you have historic outflows combined with a specific trade failure. Now let's move to the most intense period of pressure, the sequence of shocks that truly hammered market sentiment. This was a brutal triple whammy.
It was a succession of bad news hitting the tape in rapid-fire fashion.
Shock number one. The trade deficit suddenly exploded in October. What was that staggering figure?
$41 billion,
Wow.
an all-time monthly high. That number alone set off immediate alarm bells about the country's current account.
Which leads directly into shock number two. The current account deficit, or CAD, repricing shock. Before that awful October data, what was the general thinking on where the annual CAD would land?
The consensus was extremely low, very optimistic. Most economists expected CAD to hover around 0.7% of GDP, which is close to the previous year's 0.6%.
And why so optimistic?
That optimism was largely because India has recently become a significant GCC hub.
Okay, hold on. Let's make sure we unpack that. What does being a GCC hub mean in the context of the current account deficit?
The GCC is the Gulf Cooperation Council, so think oil-rich countries like Saudi Arabia and the UAE. When we say India is a hub, we mean we're seeing massive inflows of remittances and service exports, IT, financial services from those regions.
I see.
These dollar inflows help offset the cost of our physical imports, so they keep the CAD lower. The market was pricing in that positive effect.
A powerful tailwind. But then the $41 billion trade deficit hits in November. How dramatically did that change the CAD forecast?
The change was dramatic and fast. Post-announcement, forecasters immediately revised their current year CAD projections sharply upward to somewhere between 1.2 and 1.4% of GDP.
Let's challenge that 1.2% figure, though. I mean, is a 1.2% CAD historically a terrible number for India?
Yeah.
Is it crisis level?
No, absolutely not. And this is the vital piece of context for you, the listener. For the better part of the last 4 decades, India's CAD was consistently in the 2 to 2.5% range.
So 1.2% is actually pretty manageable.
Historically, yes. The catastrophe wasn't the final 1.2% number. The catastrophe was that the market was priced for 0.7%. That sudden, huge discrepancy between expectation and reality caused massive turbulence. It signals unexpected volatility.
So sentiment is more about the surprise factor than the actual fundamental risk of the new number.
Exactly. Market participants hate being wrong by that larger margin, regardless of the history.
And then the third shock. This one involves geopolitics and crude oil.
This was the third negative shock that just pushed down any remaining rupee bullishness. The market is now pricing in the high likelihood that the significant tailwind India enjoyed from cheap Russian crude oil
Will no longer be available.
That's the assumption. It's not going to be available anymore.
And why is that assumption taking root now?
Well, the geopolitical landscape is shifting. Initially, India benefited hugely from heavily discounted Russian oil. But there are rising concerns about logistics, potential adherence to G7 price caps, general pressure. The market is factoring in that future oil costs will revert to global benchmarks much faster than we thought.
And if India has to pay global prices instead of discounted prices,
It widens the trade gap. It feeds right back into that $41 billion deficit problem.
That is just a staggering combination of factors: structural capital flight, a trade deal failure, and three successive shocks, all pitted against that fantastic 8.2% GDP print.
But there's one final concern that FPI traders highlighted that ties all these threads together, and it relates directly to the quality of the GDP number,
What's that?
the concerns about nominal growth.
Tell us about that. We know the real inflation-adjusted GDP growth was 8.2%. What was the nominal GDP figure?
The nominal GDP growth came in at 8.7%. And for many investors, particularly those focused on corporate revenue, that figure is raising huge red flags. It's a multi-year low.
An 8.7% nominal growth rate sounds decent, especially next to 8.2% real growth. But you're saying the historical context makes it look weak.
It does. For the past 2 decades, if you exclude the big crisis years like COVID and Lehman, the Indian economy typically posted nominal GDP growth around 12%.
Yep.
So when you look at the basic equation, real GDP plus inflation equals nominal GDP. That 8.7% figure suggests that the underlying price increases, the inflation component, is extremely low.
So why does low nominal growth frighten investors and perpetuate this fear of muted earnings?
Because nominal growth directly dictates top-line corporate revenue. If inflation is low, companies have less pricing power. If the real volume growth, the 8.2%, can't translate into higher revenue because of that, then a company's top line grows slower.
And if the top line is slow,
It becomes much harder to generate the impressive double-digit earnings growth that investors want. So slow nominal growth implies depressed corporate earnings going forward, confirming the initial fears and keeping the pressure on FPI outflows.
so the concern isn't just about what they earned last quarter, it's about what slow nominal growth implies for their revenue stream and profitability next year.
Exactly. The market is reacting to future expectations, not past success. The currency is being driven by forward-looking outlooks and structural fears, despite the spectacular historical GDP data.
That paints a powerful and, frankly, pretty negative picture. But we always need to look for the opportunities. Are we seeing any major institutional players view this as an attractive entry point?
We are. The tide is definitely starting to turn towards some measured optimism. Major global firms, including Goldman Sachs and Morgan Stanley, are beginning to publish research suggesting Indian equities are becoming quite attractive, purely from a price point perspective.
And what's their assessment of the currency itself?
They hold a similar view. These experts are increasingly veering around to the argument that, given the underlying fundamentals, that real 8.2% growth, the Indian rupee is clearly undervalued right now.
So it's been pushed down too far by these shocks.
Disproportionately so, yes.
That provides a powerful counter-narrative. If the currency and equities are both depressed, what does that suggest for you, the listener, looking at this market?
It suggests that an attractive entry point for both the currency and for Indian equities might be just around the corner. It fits that classic market analogy perfectly.
Which one is that?
Isn't there something about the hour before dawn being the darkest?
A perfect metaphor. So for you, the listener, what we've detailed is a market where the powerful macro story of 8.2% GDP is being undercut by a confluence of unique factors. 2 years of historic capital deficits, specific trade disappointments, those devastating market shocks like the $41 billion trade deficit, and fears about slow nominal growth.
The crucial takeaway for you is to distinguish between reported economic growth and market mechanics. The currency's performance, particularly in the short term, is influenced far more by capital flows, investor sentiment, and forward earnings than it is by the headline GDP number alone.
This discussion has clearly shown that while fundamental economic strength is essential, it can be entirely overshadowed by relative market expectations. Being priced for a 0.7% CAD and then having to reprice to 1.2% is a far bigger shock than what that 1.2% actually represents historically.
Which leaves us with this final provocative thought for you to explore. If the rupee is truly undervalued, and this is merely the dark hour before the dawn, how quickly can corporate earnings catch up to that real 8.2% macro growth? And how quickly can nominal growth return to its 12% historical average before the geopolitical and trade deal headwinds dissipate? That convergence between economic reality and investor expectation is the next big story you need to track.